If you're not careful, you could be making this mistake with your covered calls. Now, not only is this going to cost you money, it's going to add a lot of stress and frustration to your trading as well. And so in this video, I'm going to talk about what the mistake is that I see very commonly and how to rectify it. If you're not familiar with who I am, my name is El-Gorr. I am the founder and CEO of Freeman Publications. I've been trading covered calls myself for the past 6 years, and I've helped hundreds of people do the same. And I've also sold a ton of books on the subject. Check it out on Amazon. So without further ado, let's get into the video and I'll show you what the mistake is and how to rectify it. So we've got the handy dandy PowerPoint presentation on the screen, and this is what to do when your covered call is in the money. So I've actually got a screenshot here, and this is a trade I'm going to be talking about on this exact call. So this is a very, very common thing. If you've been trading for anything more than a couple of months, you've probably been in this position where you sell a covered call at what you think is a fairly conservative strike price, so usually out of the money, which means higher than the current price of the stock, but the stock blows through it and keeps trading higher and higher and higher, and suddenly you're looking at missing out on big potential gains. So what do? And the number one thing is to adjust it through rolling. If you're not familiar with what rolling is, it's when you simultaneously buy back the original option that you sold and then sell a new option on the same stock. Now, rolling in itself is always going to be a combination of two things. First is extending the time in the trade, which you will be paid for as you're adding time value, because that's one of the two parts of options value, and or moving your strike further in or out of the money. The more you move it into the money, the more you're going to get paid a credit. The more you move it out of the money, the more you're going to pay a debit. And the net credit or debit on a trade is going to be determined by the combination of those two factors. And to understand why we're even doing this, we have to go back to first principles, which is, well, what is a covered call in the first place? What is the goal of the strategy? And the goal is to generate income from a stock in a fairly sideways market. And so therefore it's a limited upside, limited downside strategy. So by definition, you are never going to capture the maximum upside on a stock while selling covered calls. And that's the first thing to internalize when we're going to adjust the actual stock itself. Really, there's no need to stress over it. If you want maximum upside on a position, just buy and hold. Don't sell covered calls. Simple as that. For example, in my long-term portfolio, CrowdStrike is my largest position. Now, my cost basis on that is $143 a share, which is, I think it's trading at about $340-ish today, significantly below where the stock's trading at. So for me, I'm owning the stock for long-term potential. I don't want to interrupt that compounding by selling covered calls, because if I did, chances are that stock would have been called away a long, long time ago. And the same goes for other long-term positions that I have, like Meta, Tesla, Nubank, Datadog. I'm not going to sell covered calls on those because I don't want those positions to be called away at potentially a lower price. So that being said, what about the kinds of stocks you do sell covered calls on? What are you going to do? The mindset to have is you do not want to turn a winning trade into a losing one. Now, first of all, not every trade is going to be a winner, but if you have a winning position, don't hand back your gains. And that's what I see a lot of people doing. Just like with cash secure puts, more money is going to be lost through being greedy and trying to extract every single cent of profit than just being content with what you've got. From a mental perspective, it's also a lot more taxing to go through that process and hand back those gains than it is just to have a losing trade from the get-go. The other important thing is we have to understand realized gains, or what is real, which is the cost basis you have on the stock, versus what is unrealized. That's the potential profit, or in this case with options and a covered call, the strike price in relation to the current price of the stock. Now, Here's the attitude shift that I have that has helped not only myself but lots of other people as well. My preference is always focusing on lowering cost basis because that cannot change. The unrealized portion of the trade can always change and changes day to day, but the cost basis, unless I adjust the trade, is fixed. Now, here's what you shouldn't do, knowing that. You shouldn't pay a massive premium to roll up to an out of the money strike, increasing your cost basis in the process. So, for example, going back to that SoFi trade that I had on the first slide. SoFi's trading right now at just over $16 a share. Now, I've got a covered call on it at the 13.50 strike, and it's got about 15 days to expiration as I'm recording this. Right now, I can pay $2.05 to roll that covered call up from $13.50 to $16. So I increase my strike price. So I'm going from very deep in the money to basically at the money. Now, from a purely mathematical perspective, this makes sense to do. Because if you think about it, I'm paying $2.05 to increase my final sale price by $2.50 because my new strike is $2.50 higher. So in a vacuum, this would be a good idea to do. Now, the question is, well, why don't you do that then? Because of this factor. It doesn't take into account the likelihood of exercise. Now, right now, the 13.5 strike is at a 92 delta. So if we're going to use approximations, it's approximately a 92% chance of finishing in the money. The 16 strike is a 56 delta. So just a little bit more than half. Now, you're paying this premium to roll from a 92% chance of exercise to a 56% chance. And there's a thing that really affects us, especially with covered calls. It's recency bias. Because this is massively in the money, that means the stock has appreciated a lot in the last 4 to 6 weeks, which is what's happened with SoFi. It's gone to 16 from about 11. Now, that can always reverse. Stocks don't keep going up indefinitely. And so what if the stock falls? Now, your cost basis is higher because remember, you've paid to roll up the trade and then you've got to start again, most likely at a lower strike price. So you're faced with this scenario where your cost basis is higher and now you're selling covered calls below where your cost basis is. So you've got to completely redo the trade and fight out of a losing position, which is the last thing that you want. Now, the common retort to this is, well, the stock's going up. Surely you want to stay in the trade. Once again, that's just recency bias. If the stock's gone up in the past 2, 3, 4 weeks, it just makes you think that upward momentum is going to continue and never going to stop. And it's the same way when you get assigned on a CSP, feels a lot worse than it is because you think the stock is going to keep falling and falling and falling. And that's kind of the hard part if you're doing the wheel, is just getting over those mental hurdles in the beginning and understanding that just because you've had a week of bad momentum or a week of good momentum on a stock, it's not going to continue forever. There's no guarantee the stock's going to continue going up. And you don't want to hand back your profits if it reverses and then goes down. Because now, once again, you're stuck with a massively out of the money trade, which you'll have to let expire or start again at a lower strike price. And trust me, I'm speaking from experience on this, how frustrating that is. This isn't just something I've made up, this is something I learned through experience. Handing back your profits is the worst part of trading. No matter if you're doing stocks, commodities, options, futures, no matter what it is, handing back your profits is the worst part. And these mental setbacks, they often compound, leading to more poor choices. So what do you do instead? Going back to SoFi. Now, I own SoFi at a cost basis of about $11.62. Now, I've got this covered call. It's at a 13.5 strike. It's got 15 days to expiry. like I said, that's about a 92 delta as I'm recording this. Now, if I let this expire today, my profit's going to be $1.88 per share. So just letting it expire, not the worst plan in the world. But let's see if we can actually improve upon this. Now, I've got a few choices here, and these are all based off actual option price data that I grabbed from Tasty Trade about 30 minutes before I'm recording this video. Now, my goal here is to increase my sale price without increasing my cost basis. And this is going to be done through a combination of rolling, but am I going to roll out? Am I going to roll across? Straight away, there's going to be a balance. Rolling in the money trades is always a balance between adding time value to the trade and subtracting intrinsic value when you're rolling up the strikes. And this is going to net out your debit or credit on the trade. Now, here's the first choice I have. I can roll from 13.5 to 14 with the exact same expiration date. Now, this is a terrible move. There's basically no time value at all with this particular choice. So I've got to pay 48 cents to roll 50 cents higher. So if we factor in commissions, there's basically zero benefit at all there. So it's not worth it because I'm going to get 1 cent worth of gains. Now I've got a higher chance of the trade not working out in my favor as well. Choice number 2 is the one I had earlier. I can go from 13.5 to 16. Same expiration, but I can just roll higher. Once again, 205 I'm going to pay with 250 potential higher sale price. Now that's better than the first choice, but it's still not worth it due to the much higher chance of the trades not working out in my favor. Choice number 3 is I go from 13.5 to 16, but now I roll further out. So if I go 28 days further out, I go from 15 days to expiry to about 43, I'm going to still pay a debit. Still got to pay. I'm paying $1.46. So now I'm paying $1.46 to go $2.50 higher on the eventual sale price. However, now I've got a much lower chance of exercise and the added length of time for a potential reversal in the trade because I've added another month to that. So I don't really want to do this either. However, the fourth option I found was the best one. That's rolling from the same strike, but 28 days further out. Now I'm going to get paid 40 cents for doing that. So my cost basis is 40 cents lower, but the eventual sale price is still the same. Now, this, for me, is the optimal move here. My downside is protected because of that lowered cost basis, but my overall profit level on the trade is higher than if I let the original trade just run to expiration. The only thing I'm losing out on really is time value, but I'm okay with that because this is a winning trade and I just want to extract a little bit more profit out of it. Now, if you're saying, hey, but by extending your time in the trade, isn't that going against what you said about the chance of reversal? Yes, but the chance of reversal to that degree is so much lower than it is with the previous choice of me going from 13.5 to 16. I think with the deltas, it was going from a 92 delta to an 86 delta. So it's still a very, very high chance that it finishes in the money. And hey, if we get a little bit closer to the expiry this time, and let's say the stock's fallen a little bit, I'm going to have a chance to roll again and still potentially get a higher exit price, but now with an even lower cost basis. Now, a few general notes on rolling, because I've also seen people approach this the other way, which is they end up rolling 6 months out just to get a credit. You shouldn't do that. Now, I don't like rolling more than 60 days ahead of where your trade currently is. So if you've got 10 days to expiry on the trade, don't roll out to more than 70 days to expiry. First of all, the premium you receive per day completely falls off a cliff the further out you go. If you go beyond 60 days, the premium per day shrinks massively. The other thing is, it locks you into a trade with a lot less flexibility. And so you don't want to be in a position where it's November 2025 and you've rolled all the way to June 2026. So now so much can happen in that 6 or 7 month time period. You're going to have at least 2 earnings calls, maybe even 3. The stock could go all kinds of ways in that 6 month period. Now you're locked in to that expiration date and there's not much flexibility you have. So that's a general note on rolling. And for me, this whole process, this whole systematic process, that's how I get results and that's how we've been able to get results for our students. A couple of people from our community in the last couple of weeks alone. Anthony, going on his trip to Japan, he did a 56.3% ROI in his account in the past year. Then we got Phil with his first 6 months working with us, 33.96% annualized returns in a 6 month period. Compare that to the SPY, we're beating that. Compare that to the NASDAQ, we're beating that, to the Dow, whatever you want to compare it to. Great results. And it all comes from doing things systematically as opposed to just using discretion or emotion or, whatever the moon is saying that month. So if you are interested in, having someone look over your trades and give you some pointers and really have that feedback loop where you can become a better trader while still managing your own account, we do have a coaching program. If you want to speak about it, the link is down below. But if not, I hope you enjoyed this video and I will see you in the next one.